I'm Ed Althof. I'm with Loesel-Schaaf Insurance Agency. Loesel-Schaaf was established in 1926. I've been with the agency for the past 30 years. I've been in the insurance business for 40, but the last 10 years I've been specializing in long-term care planning. I've put together a team of people, 2 living in Pittsburgh, 2 of us that have ties to Pittsburgh that are servicing the Pittsburgh marketplace. Mike Osilka is a long-term care specialist. Dr. Joel Waldman is a disabled dentist. He also works for the Pennsylvania Dental Society, advising their members, and Penn State University, advising their employees. Kendra White lives in Pittsburgh. Kendra has dual masters in caregiving and gerontology. But let me tell you a little bit about my experience and my ties to Pittsburgh. A little over 10 years ago, we got a call out of the blue, and my wife and I became caregivers from that point on. For the next 10 years, we were actively involved in the caregiving of her parents, who lived in Pittsburgh, West Mifflin to be precise. This took us by surprise. What ended up shortly thereafter happening is we started on a journey of being in Pittsburgh 1 workday a week for the next 7 years. We needed to be in Pittsburgh, having picked up my mother-in-law in Munhall, and be at Jefferson Hospital by 7 to 10 after 7 once a week. You can just tell with the thinking 1 day a week causes some not only anxiety, but there was some financial. And that's primarily what we're going to discuss, is the financial, emotional, and physical needs of the caregiver. Like I said, we did this for the next 7 years. We were glad to do it. But in the process, some of the retirement planning that I had done took second string. We had planned on, my kids are both teachers. My son teaches in McKeesport. He, at this point, was starting to have grandchildren. We missed a lot of the grandchildren growing up, but we were spending the 1 day at the hospital. Yeah, the retirement planning that we had done up to that time had us, once the kids had graduated from college, once the expenses of helping the kids get on their feet was over, then we would start increasing my contributions to my retirement plan. What ended up happening is the kids graduated from college. Thankfully, they got married shortly thereafter. Then the call came from the in-laws. For the next 7 years, we were not in a position to increase the retirement savings. Fortunately, I feel fortunate in that I love what I'm doing, and I didn't have an exact retirement date in mind. So as long as things are going good, I'll continue to do this. My wife, on the other hand, she was able to keep her job for about a year, and then we decided that she would retire, that her day-to-day activities with them, even though it was at a distance, was too much to do and work. So that took a hit on the retirement planning. So this is just to give you an idea of some of the caregiving stuff that takes place, and then we're going to start the presentation. Thank you for your time. Now we'll go on to the long-term care education and planning program. We're going to talk about the 4 stages of planning: education, discussion, decision, implementation. Many of you have already gone through these stages or are somewhere in the middle of this. For the ones that have completed this and have made some plans, we greatly applaud you. For others, this may be the influence to get you to start through this. We're going to cover the misconceptions associated with chronic long-term care. I'm going to talk to you about the value of early comprehensive long-term care planning. We're going to talk about transferring the risk. This topic is a topic that's getting much more play in the media. We've got people on the radio such as Kiplinger, Ray Lucia, Susie Orman on TV. We've got many of the national syndicated financial planners talking more and more about it. including all of the magazines, Money, Fortune, Forbes, and so on, Kiplinger. The first thing that used to come to mind when I heard chronic long-term care was two things. One was it was at a much older age, and the other was it was a nursing home. Long-term care is not a place, it's an event. It's an event that can happen at any time and at any age, and I'll give you some examples. This is what long-term care actually is. Requiring assistance with 2 of 6 activities of daily living: bathing, continence, dressing, eating, toileting, transferring. To have 2 of 6 of these activities of daily living, you are either disabled, chronically ill, or cognitively impaired, and you're going to see we're seeing much more of the cognitively impaired, both with our parents and our peers. Hands-on or supervisory, expected to last 90 days or longer, certified by your family physician. To me, this is the most important slide that I have. If my children were living across the street from me, I would not want them providing my care. I would want them to supervise my care. Supervising the care is a situation that's being made much more easier by the physicians and the online tools to be able to do it from anywhere in the country, anywhere in the world. Providing the care is hands-on. Providing the care means you're disrupting your life. Planning allows them to maintain their relationship with you as spouse, children, or friends versus the role of caregiving. Part of my passion is because of this statistic. Over 50% of families fall apart when a loved one needs care. This planning helps preserve their emotional and physical well-being. Our kids need to be mothers, grandmothers at the appropriate times, fathers, grandfathers, not in the situation where they're taking care of us, not providing the care. We're going to talk about the misconceptions that we hear. It won't happen to me. I'm already covered. My family will take care of me. I have enough money to pay for my own care. Long-term care insurance is too expensive. Well, we're going to walk you through these and see what your thoughts are after we walk you through. Most of us will agree that we believe we will make it to age 65. At age 65, we have a 70% chance of needing long-term care coverage at some point in our life. 43% of the people in claim today are under the age of 65. I have at this point 12 people under claim, and all of them are under the age of 60. The most recent is a person that was diagnosed about a month ago, 53 years old, with ALS, Lou Gehrig's disease. There you can see, a large percentage of the baby boomers are going to have some type of cognitive issues, but we're already seeing that with some of our parents, aunts, uncles, and such. This is a big misconception. I'm already covered. Well, we're going to walk you through each. Health insurance. The health insurance I have on my life, I pay dearly for. It is going to take care of 99.9% of the things that take place for myself and my wife as long as I am working. That 0.1% is the situation in a serious claim. I have a stroke, I'm in an accident, and I'm just not recovering. At that point, it's called custodial care. Custodial care is not covered by any insurance carrier, so it doesn't matter who you have, it's covered by you spending down your assets. When I say spending down assets, typically we're talking about equity in a home and retirement vehicles. Disability income is to provide replacement of income due to disability, meaning to pay the rent, to pay the mortgage, to pay a car payment, to buy food. It replaces your check in case of a disability. The Social Security statements that we received for years very clearly in bold print state that Social Security and Medicare are not there to take care of these custodial long-term care items. Medicare, though, has a very good provision in their coverage, and it's a rehabilitative care. Rehabilitative means the nursing home, it requires 3 days admission to a hospital. So it's coming out of a hospital, preparing us to go back to our own, living on our own, or even to an assisted living place, but going back to where we were pre-hospital. Rehabilitative stops the day we are no longer advancing in our care, but it's a great benefit. The first 20 days is paid for in full. 21 to 100 days is paid at 75 to 80% by Medicare. Very limited coverage under Medicare supplements. My family will take care of me. This is the way it was done 100 years ago. But 100 years ago, it was the job of women. Everything has changed in the last 100 years. Family taking care of us is much more difficult than it ever was before. Like I said, even if my kids were living across the street from me, I would not be looking for them to become caregivers. 20% of caregivers cut back work hours to part-time. 48% lose job or change shifts or miss career opportunities. 80% report contributing financially for care. 24/7 is very difficult. 1 day a week is very difficult. Everything in between is very difficult. This slide is the latest published numbers. Everybody tells me how these are underpriced for the Allegheny County. I understand. These are 2012 numbers, Pennsylvania average. So Allegheny County, Erie County is much more than the average in the state. And then you take these are 2 years old. So yes, a number of people have been telling me this is much less than what they are paying themselves for this type of care, and I understand that. But even so, then we're looking at, to just get into the ballpark, some pretty high prices all the way around. Somewhere, skilled nursing somewhere in the average of $100,000 2 years ago, $40,000 for assisted living. Next step in planning is having the courage to have a candid conversation with your spouse and family and ask, what is our plan to protect our most important asset, our family? Who will care for me? What if we both need care at the same time? Chances are, if my wife and I need care 20 years from now, we both will need care fairly close to the same period of time. That has been my experience. Where are we going to provide care? How is life going to change for us and our caregivers? People purchase long-term care insurance to protect our loved ones while they are still alive. It offers our loved ones the opportunity to supervise the care rather than reorient their lives and provide the care. It allows them to maintain their relationship with you as spouse, children, friends versus the role of caregiving. It helps to preserve emotional and physical well-being. Like I said, 50% of families fall apart, and financial is a major reason. This is sort of a simplistic chart, but it just goes to show the top left-hand homeowners claim 1 in 1,200. Right upper automobile claim 5 in 1,200. Lower left large medical claim 105 in 1,200. Long-term care at age 65 720 in 1,200. So it's just to visually show you what we're talking about. Long-term care insurance is designed to provide a steady, dedicated stream of income for your care. helps to minimize the financial, emotional, and physical impact on your family, helps protect income, assets, and financial future, makes a difference in the access to quality care. Preserving independence is very important to me. I would like to be taken care of at home as long as it's feasibly possible. This allows you to stay at home longer with appropriate care. Allows your investment retirement portfolio to execute for the purpose intended, minimizing or eliminating taxes and passing assets to the surviving spouse available. Now we're going to go into the LifeSecure. LifeSecure is the insurance carrier, the overall program. The program is available to your spouses and family members. You would choose a benefit pool. As an example, because we're going to use this later, $100,000, a monthly benefit that you would take out of the pool, and I'm going to use the example of $3,000. That would determine a monthly premium. There would be a 90-day calendar day elimination period. Automatically, there's a waiver of premium when somebody's in claim, and a number of optional riders that we'll come back to. But the two most popular ones are the 3% or 5% compound inflation and the money back promise. LifeSecure's long-term care coverage qualifies under the Pennsylvania Partnership Program. What is the partnership plan? This is a plan where the partners are the state of Pennsylvania, the federal government. 49 states participate in similar partnership programs at this point. So the federal government, the state government, who make up Medicaid, LifeSecure, and then you become a partner. You're the only one that has an option to cease the partnership, and that would be by not paying the premium. As long as you pay the premium, the partnership is guaranteed for life. But what the partnership plan does is, if I were to go into a skilled nursing facility, and it's strictly skilled nursing facility, I get a dollar for dollar protection based on the amount the policy is worth the day I go into the skilled facility. So the example here is, if I go in and there's a $200,000 is available in my policy, I'm able to protect $200,000 of my personal assets, retirement assets, whatever, from the spend down under Medicaid eligibility requirements. Spend down being spending my assets down to, at this point, qualifying for Medicaid is basically a $2,200 proposition. I would spend my assets until I have $2,200 remaining. But the state and federal government puts in a requirement, and that requirement is for 75 and under, I must purchase either the 3 or the 5% compound inflation protection option. Over 75, I do not, any plan qualifies, but between 3 and 5% is a requirement. The simplified underwriting program is very important, and it's very important that you listen to this, because this truly, truly is a once-in-a-lifetime opportunity. It's only available to full-time employees and their actively at work spouses. If you meet those requirements, then you would answer yes or no to 6 health questions. If you answer no to the 6 health questions and are within the height weight parameters of LifeSecure, then you have guaranteed coverage. We would not be seeking doctor's reports. There's no physical, there's no anything like that. It's just these 6 questions in being within the height weight parameters. This is a once in a lifetime for existing employees, and at this point it's limited to applications taken from November 1st to January 29, 2015. To give you a basis of what the cost would be for a $100,000 pool that would pay out up to $3,000 a month after a 90-day period, if I was 50 years old, the cost would be $49.42. If you look at the fine print there, if I had a spouse that I was covering and she applies and is approved, both our premiums would be reduced by 30%. These are the full rates for a single person, but the 30% would be factored in. The pricing is not in 5-year bands. That's just an example. So a 47-year-old would pay a 47-year-old price, as would a 57-year-old. The premium is designed to never go up. It's locked in at that price with one major caveat. All insurance companies in the United States have the ability to petition the state of Pennsylvania, lay out their case for a rate increase, showing that the claims were greatly misunderestimated and that they're seeking a rate increase. This is less likely to happen at this point only due to the fact that these rates have been in place for a little over 6 months. So everything that has happened to the economy has been factored into the rating already. The rates are designed, but there are no guarantees. Why would you purchase now? The coverage will never be as inexpensive as it is now, especially with the discounted program. Health is the major thing that takes place in here. And with younger lifestyles, with the driving, everything that we do, accidents and injuries are just out there. Gives you the ability to balance the money you put into retirement with the cost of a long-term or extended care policy. As you know, modern medicine is diagnosing diseases earlier and extending our lifespans longer. We are seeing the tightening of underwriting taking place each and every year. So this is the one coverage where you cannot just put it off and decide on your own when you need it. You're able to do that as long as you're healthy, but very likely not after that point. Premiums are based on age, health, and plan design, and you are just never as young and as healthy as you are today. We would like to talk to you anyway, even if you're not able to get it under simplified underwriting or have health issues, because we may have plans. The next step would be to meet with one of our long-term care specialists. That could be over the phone, screen sharing software, at the school, whatever is appropriate. But we would walk you through it, give you pricing. You are also able to go onto our website and link onto the LifeSecure. We've given you the information to be able to do that, so that's also available. So with that, thank you for your time and have a great day.